All right, let's just dive right in. A lot of us think about our financial lives like a straight line. You work hard, you save some money, and hopefully you get to retire someday. But what if the system we're all playing in is less like a straight line and more like a game? A really complex game, with a set of rules that, let's be honest, aren't always spelled out for us. Figuring out these rules is the real key to winning. So let me just pose this question. We're always told to build wealth with stocks, or real estate, or maybe a business. But what if the single most powerful tool you could possibly have isn't an asset you can buy? What if it's a specific, kind of obscure rule buried deep in the thousands of pages of the tax code? That's exactly what we're going to dig into. So why do these hidden rules even matter? Well, to really get it, we first have to look at what we're all told are the pillars of financial security. And as you're about to see, what most people think are solid rock foundations are actually, well, they're built on sand. And some pretty big cracks are starting to show. Let's start with the big one, Social Security. When this whole thing was created way back in 1935, the full retirement age was set at 65. But here's the crazy part. Back then, the average life expectancy was actually less than that. The system was basically designed so that most people wouldn't even live long enough to collect much, if anything. Now, fast forward to today, the retirement age has barely moved. It's 67, but our life expectancy, it's shot up to almost 80. You see the problem, right? This huge demographic shift creates a massive imbalance. We have way more people living way longer, collecting benefits for decades. So what's the result? Well, the projections aren't great. By the early 2030s, the Social Security Trust Fund is expected to be pretty much empty. At that point, the money coming in from taxes will only cover about 75% of the benefits that have been promised. The takeaway here is simple. The safety net has a big hole in it. You have to create your own. Okay, so if Social Security is on shaky ground, what about that other pillar? The good old-fashioned strategy of just saving cash, putting it in the bank. Well, unfortunately, that foundation is crumbling too. It's just happening so quietly you might not even notice. And the culprit is inflation, that silent thief that just eats away at your money's value day after day. And if you want to see just how powerful this erosion is, just look at this number. In the year 1900, an average American home cost about $5,000. Today, that same average home is around $417,000. It's not that the house itself is that different, it's that the dollar you use to buy it is worth a tiny fraction of what it used to be. Stashing your wealth in cash is basically like trying to carry water in a leaky bucket. So, if those traditional pillars are so unstable, what's the move? The answer isn't just about trying to earn more money. It's about a total mindset shift. It's about moving from just earning an income to owning the assets that produce income. This is the real playbook for building wealth that lasts. This quote just nails it. The secret to joining the richest 1% isn't how much you earn, but what you own. Think about that. A high salary is fantastic, but it's also highly taxed, and it can go away tomorrow. Ownership of a business, of real estate, of intellectual property, that's what creates true financial freedom. And listen, the numbers don't lie. When you look at how the wealthiest people in the world actually made their money, what do you see? A massive 75% of them are entrepreneurs. They own businesses. Another 15% are investors who own assets. The common thread is ownership. They're not just trading their time for money, they own the machines that make the money. Okay, so the path seems pretty clear, right? Own assets, like rental properties, generate passive income. Simple enough. But this is where the game gets interesting. Because for high-income earners, doctors, lawyers, successful execs, there's a hidden barrier, a rule designed specifically to stop you from really taking advantage of this strategy. This barrier is called the Passive Activity Loss Rules, or PAL for short. They showed up in the Tax Reform Act of 1986. Basically, the government saw that a lot of high earners were using real estate's paper losses, deductions like depreciation, where no actual cash leaves your pocket, to slash the tax bill on their day jobs. So the PAL rules were created to put a stop to that by splitting your financial world into two separate buckets: active and passive. I want you to picture a solid brick wall running right down the middle of your finances. On one side is your active income, your big W-2 salary. On the other side is all the stuff from your rental properties, the income, and more importantly, the losses. The PAL rules say that any losses on the passive side of that wall are stuck there. They cannot cross over to reduce the taxes on your active income. They're trapped. And this really nerfs the tax-saving power of real estate for most high earners. But hey, just like in any game, if there's a wall, there's usually a secret key or a hidden passage somewhere. And in the tax code, there is a key. It's a key that lets you legally smash right through that wall, reclassify your losses, and make them unbelievably powerful. So here it is, the two-part key. It's often called the short-term rental loophole. First, the average stay for a guest at your property has to be 7 days or less. So think Airbnb, not a standard 12-month lease. Second, you have to materially participate in the rental. Now, the easiest way to pass that test is to spend at least 100 hours a year working on it. That's only like 2 hours a week. And you have to spend more time on it than anyone else, like your cleaner or property manager. Now get this. When you meet those two very specific conditions, the tax code has to change how it sees your rental. It's no longer a passive activity. It gets recharacterized as active. And just like that, you've blown a hole clean through that wall. The losses from your real estate can now flood through and directly attack your active income from your job or business. So, now that we're through the wall, it's time to bring in the heavy artillery. We're about to talk about a way to create not just little losses, but massive paper losses that can vaporize huge chunks of your taxable income. And it's all thanks to a magical little concept called depreciation. The tool you use for this is called a cost-segregation study. Normally, you have to depreciate a residential property over a super long time, like 27.5 years. But a cost-segregation study is where engineers come in and basically break the building down into all its little pieces for tax purposes. The carpet, the appliances, the light fixtures, and all those little pieces can be depreciated way, way faster, over 5 or 7 years instead of 27. And the difference is absolutely staggering. With standard depreciation, you get a tiny little deduction each year. But by using a cost-seg study to accelerate depreciation, you can pull forward decades worth of deductions and cram them all into the first few years. You're not getting more deductions overall, you're just getting them now. And because of the time value of money, $1 in tax savings today is worth a heck of a lot more than $1 saved 20 years from now. Let's walk through a quick example so you can see the magic. Say there's a lawyer, she makes $300,000 a year. She buys a condo, runs it as a short-term rental, and meets the 2 rules. Let's say the condo brings in $70,000 in rent, but she has $40,000 in expenses. Now her cost segregation study gives her a monster $120,000 depreciation deduction in year 1. First, that deduction wipes out her rental profit. Then the leftover $90,000 loss flows right through that wall and reduces her taxable salary from $300,000 all the way down to $210,000. The tax savings are just enormous. So, as we wrap this up, it's really important to see that this isn't just some cute tax trick. It's a full-blown strategy for financial self-preservation, especially in an economy where the old rules just don't work anymore. In a world with runaway inflation and shaky social safety nets, being able to control your own tax bill is, well, it's a superpower. Understanding the tax code isn't just about optimizing anymore. It's about preserving what you've worked so hard to build. It lets you go from being just another player in the game to someone who's actually designing their own financial future. The whole financial system is a game. It has a detailed rule book, the tax code, and it's available to everybody, but almost nobody bothers to read it. The strategies we've just talked about, they're written right there in black and white. So the only question left is, now that you know some of the most powerful rules, how are you going to play the game?